We are all in a situation where we see the problem, we see the uncertainty, we all anticipate a potential shock. But if we look at our indicators, they're all very good. I mean, the stock of NPLs is going down still, and the cost of risk is still compressing. And we had a slower October, November, but from December, the pace, both in the corporate sector and at family level, has increased.
So you don't see that accelerating actually this year? Again, you don't see a kind of delayed impact of some kind of shock?
It depends very much on where we're going to land in terms of rates, inflation, and GDP. At the moment, Unicredit felt that we were going to have a shallow recession this year. At the moment, we would tell you that we're going to have potentially a 0 to slightly positive economic growth in Europe. Now, there is a lot of risk. The geopolitics, the war, the value chains, how much the interest rate increase is going to hit the economy. All of that are risks. But if we look at the indicator today, we're not going to a recession. We're going to stay on a flat. And even inflation, our view is that we're going to have an average of probably 6% for the year, but the exit rate is going to be closer to 3%. So if that happens that way, then that is quite good news. If it doesn't, we need to be prepared for a shock, but we don't know.
So that means what? Extra provisioning? Extra cleanups?
Well, we have taken the view of managing for what we see, i.e. relatively optimistic, but taking big buffers in case we're wrong. So we've created overlays over normal provision. At 9 months, we were already 1.3 billion and indicated we would increase them further in the fourth quarter. And that for us is saying, okay, the business is going like this and we're managing that way. But if we're wrong, I have a big buffer equal to 1 year of cost of risk to complement whatever hits me.